The gold price traded $100 below this month's new all-time record high of $2,430 per troy ounce in London on Wednesday, steadying from the past fortnight's volatility as long-term interest rates rose, Western stock markets slipped, and major news outlets caught on to the impact of speculative trading in Shanghai gold futures and options. Gold's record-setting rally may have its roots in Chinese frenzy, says Bloomberg today. Chinese speculators supercharge gold rally, agrees the Financial Times, also highlighting data from the Shanghai Futures Exchange. Gold price sets eighth record in a row amid China speculation and hype warnings, said BullionVault more than 2 weeks ago, adding last Wednesday that China's gold investment is strong on mixed data at $2,400 and pointing to SHFE options trading last Thursday. Shanghai gold exchange prices today rallied to 548 yuan per gram at the city's afternoon benchmark auction, 1.0% above Tuesday's 3-week low and holding the premium over London quotes. Effectively, the incentive to import bullion into the world's #1 gold consumer nation at $25 per troy ounce, more than 3 times the long-term historical average. Gold bullion in London then fixed above $2,300 per troy ounce for the 13th session in a row Wednesday afternoon, showing a 13.3% gain since this move began at the end of February, when Russia's President Putin said that NATO's support for Ukraine risks nuclear conflict. Silver rallied close to $27.50 per ounce, over 80 cents above yesterday's 12-session low, after fixing at London's midday benchmark 21.2% higher from the start of March. Shanghai silver premiums had earlier held above $3 per ounce after reaching the smallest in 2 weeks. That incentive for new imports has now averaged 10.0% versus London quotes across the past 6 months. Chinese speculators have really grabbed gold by the throat, the FT quotes market strategist John Reed at the Mining Industry's World Gold Council. Emerging markets have been the biggest end consumers for decades, but they haven't been able to exert pricing power because of fast money in the West. Now we are getting to the stage where speculative money in emerging markets can exert pricing power. Samson Lee, a Hong Kong-based analyst at Commodity Discovery Fund, sees a more nuanced picture, says Bloomberg. Rather than being a direct driver of prices, the frenzied demand in China has encouraged Western speculators to ramp up bets on gold derivatives gains in New York. Asian stock markets jumped overnight, but European and American bourses fell Wednesday after new US data said the world's largest economy saw a smaller than expected jump in durable goods orders last month, raising doubts over the already lower consensus outlook for tomorrow's first quarter GDP report. Western government bond prices also fell, however, driving long-term borrowing costs higher, and with inflation-protected 10-year US yields hitting the highest since November, ahead of the US Treasury, selling a record $70 billion in 5-year debt later today. China's long-term borrowing costs meantime jumped, but from historic lows after Beijing's central bank warned against betting on continued weakness in the world's second-largest economy. Due to its weak growth and poor financial markets boosting household and investment demand for bullion, China is driving up global gold prices, said Newsweek a fortnight ago, as the precious metal set its current all-time high. Please like this video and subscribe to our channel.